August 2025, question 21, BDA. This question wanted us to prepare to go through the trial balance of Farasi Limited, which has prepared the following trial balance. This is the trial balance for Farasi Limited. We have from revenue all the way to, so revenue, cost of sale, all the way to the suspense account. Then, additional information. The following depreciation rates apply. You can see building at the rate of 5%, straight line method, it's going to admin. Plant and equipment at 25%, that is reducing balance to the cost of sale. So they're saying that land was revalued to 2.4 as at 1st March 2024. Then additional information number 2, income tax expense for the year is 78 million and deferred tax expense. Now beside that arising from revaluation, that is 78 million and deferred tax expense. So beside that arising from revaluation above is 20 million. The one arising from revaluation is 20 million. So beside this, the interest on loan stock is paid semi-annually on 1st April and 1st October. The investment properties had a fair value of 122 as at 1st March 2024. The suspense account relates to the issue of 2 million new ordinary shares for shillings 120 per share. One share has a par value of 100. The company has not adjusted for credit loss of shillings 15 million. The expected credit loss on the remaining trade receivables is determined from the following probabilities of default. So that is the expected credit loss. So here we'll be getting amount times the probability, then we come up with the expected credit loss. And this is taken to the selling and distribution cost. Now for publication, according to IS1, the statement of profit or loss and other comprehensive income, the statement of changes in equity, and then the statement of financial position. So let us prepare. So having come up with the above title, then of course, and also the accounting policies and other explanatory notes, this is like our workings. We want to start solving the question. Now the first item on the statement of profit or loss is revenue. So bring in revenue. You can just do equal sign, then pick revenue on the other side. We have revenue on the other side and enter. So that is revenue. Or just write revenue, why not? You can just write revenue. Was revenue affected in any additional information? Revenue from number 1 to number 6, revenue was not affected. So revenue was not affected. We use it as it is. So revenue was 12,490. So that is 12,490. It remains as the other one. Revenue. Then something affected the cost of sale. So I want to start by calculating depreciation. So note 1 will be depreciation expense. Depreciation expense. That is note 1. Depreciation expense. Now depreciation expense is affected by additional information number 2. Number 1, building 5% straight line, plant and equipment 25% reducing. That one goes to the cost of sale. So start with building. Depreciation on building. So asset, amount. So we have rate, charge. Now the first one is building. We do building, the one for building. The value for building, 3,030,000. That is 3,030,000 at 5%. So 3,030,000 at 5%. 30,30, 5%. Now the amount of depreciation will be equal sign 30, 30, then multiply with the 5%, 151.5. Now from building, there is another one. There is another depreciation. Plant and equipment, 25% reducing balance. So there is plant and equipment, plant and equipment. (25%) reducing balance method. Of course, the cost of plant and equipment, because it's reducing balance method, 372, then 167. So 372. And we can start by putting the cost, then accumulated depreciation. So 372, 167. The net book value would be the first one minus U12, 205. Net book value. Now, because they said we use reducing balance method, what is depreciation? 205 times 25%. The 205 times 25%. Unless I used a wrong figure there. Now, note 2, cost of sales. We have the reported balance, then add depreciation on plant and equipment. So add depreciation on plant and equipment. On plant and equipment. So the reported balance of cost of sale is 94. Depreciation of plant and equipment is 52. The total is the summation of those two, and we have the amount that goes to the profit or loss. So cost of sales will be 9451.25. Now it should be a negative, equal sign, then negative, because we are deducting it from what we have up there. Get the gross profit. Gross profit. A gross profit will be alt equal. Just do alt equal and we get that gross profit. Gross profit. After getting gross profit, we have investment income. Investment income. So the investment income can be put there. Investment income. It wasn't affected. So the investment income remains 120. Investment income is 120. Any other income? Any other income? Now, we want to check for, I think that is all. We move to expenses, starting with selling, then administration. So we have the selling, then we have administration expenses and how they were affected. Selling and then administration expenses. Something that affects selling, selling is affected in additional information number 6. The company has not adjusted for a credit loss of 15 million. The expected credit loss on the remaining trade receivable is determined from the following probabilities of default. So we want to adjust for this credit loss, that is a bad debt. Then after adjusting for this bad debt, you also do expected, that is like a provision for bad debt. Then that will also affect the selling and distribution. This is a selling and distribution cost. So we start with expected credit loss, carried down, and that is not 2, not 3. Expected credit loss, brought down, start with brought down. So expected credit loss brought down is here, 58. Then this should be moving down. So expected credit loss should move down. And this is just expected credit loss. Expected credit loss is from a probability, and we are going to calculate that probability from the figures that have been given. Additional information number 6, the expected credit loss amount and probability. We copy, then paste on the other side, just paste on the other side, amount and probability. So we have here amount and probability. Amount and probability. So based on this amount and probability, we calculate something, equal sign, bracket, this amount times probability, close bracket, plus, open bracket, this amount times probability, close bracket, plus, open bracket, this amount times its probability. So we are getting the weighted average. Then enter. 68. 68. Now, is it a decrease or an increase? You can see this is increase in expected. Increase in expected credit loss. Just like increase in provision for bad and doubtful debts, we are going to have the increase in this. So that will be 58 minus 68, 58 minus 68. Now it's an increase, and this will be an expense that will go to selling and distribution expenses. Not 4, selling. Not 4 should be selling and distribution expense, selling and distribution expense. Reported balance. Now the reported balance is for selling and distribution 918. Then increase in allowances, increase in provision for expected credit loss, or increase in expected credit loss. Now the increase is 10. Increase is 10. Then additional information number 6 also talks about some two things. Number 6 has not adjusted for credit loss. So this credit loss. Now credit loss is bad debt written off. Bad debt written off, that is credit loss. So the credit loss that has not been adjusted is amounting to 15. So the 15 bob here, that is a credit loss. Talk about actual credit loss. Just like a bad debt written off, and we talked of 15. Add alt equal, then that will go to SOPL. This will be equal sign, then you click on 943. Now for administration expenses, the reported balance is 1062. That is 1,602 million. Enter. It was affected by depreciation. You add depreciation on the first thing, depreciation on building. Depreciation on building amounted to 151.5. The 151.5. Enter. Confirm if any other thing affected administration. Not 1, yes, we have adjusted for that. 2, no. 3, 4, 5, and that is all. Alt equal to add, then it's 1,753.5. So this will be equal sign, then pick your total administration expenses. Now, but before you get finance cost, you want us to get operating profit. That is the profit before interest and tax. Profit before interest and tax. Profit before interest and tax. Now the profit before interest and tax, alt equal. Now there is one thing I didn't do correctly. This one should be negatives. The selling and distribution, make sure they are negatives, equal sign negative. Then admin expenses, equal sign negative as well. Negative. Investment income, that's an income. So this is equal sign negative. Finance cost. Finance cost. Now remember, the investment income is a positive. The selling and distribution negative, admin expenses negative. Finance cost, not 6. Finance cost, or it can just be used because it's affected by, okay, finance cost will be total to SOPL, the total to SOPL. Semi-annually means you take 4%, they said for semi-annually, 4% times the amount of the loan. Now the amount of the loan was, remember they said in additional information number 3, the interest loan stock is paid semi-annually. So that means 2 periods, 1st April and also 1st October. Now semi-annually times, so if per annum is 8%, then semi-annually it will be 4%, but now periods will be 2 periods. So that is 4% times 1825. 4% times 1,825, but now times 2 periods because we have 2 periods. So that would be 4% times 1,825. Put that in bracket, then times 2 periods. That is 2 periods. I did not start with an equal sign, so no answer. So start that with an equal sign. So equal sign bracket, 4% times the amount of the loan times 2 periods gives you 146. Less interest paid. So less the amount of interest that was paid. Now interest paid was given. So the interest paid on loan stock was 64. That was 64. So you are lessing the 64. That will give you accrued interest on loan stock. Accrued means the one that was not paid. Accrued interest on loan stock. So that will be equal sign, then 146 plus that other item. Now the best way, if you want to avoid so many other issues, the best way to deal with this, you just bring the loan. So there is year 1, then there is opening balance. Opening balance is finance cost, the finance cost. Then there is interest paid. Then we have the closing balance. Closing balance at the end. I'll be preferring this as opposed to the other way. Now the opening balance of the loan was 1825. So equal sign 1825. The finance cost is 146. We've gotten 146. The interest paid is 64. So the interest paid was 64. Then what is the closing balance? Now the closing balance will be the opening balance. You add the finance cost of 146, then you also add or you less the 64 because it's a negative, simply less. So that can be a table representing how the loan was amortized. The finance cost will be 146. Finance cost will be 146. So equal sign, negative, then you click on 146. That is our finance cost. Do we have any other item? Any other item? None. None. So get the profit before tax. Profit before tax. Profit before tax. So profit before tax is 316. Then go for the income tax expense. Income tax expense. Income tax expense. Income tax expense with note 7. You guys are not talking. Alex and Tim. Note 7. Income tax expense. Income tax expense. Note 7 is about income tax expense. Now, on income tax expense, we want to start with deferred tax. What is deferred tax? Or before we even do deferred tax, I think that will not give us a correct answer. So you can skip that a bit. I want to start with the revaluation so that I can get that arises from the revaluation as well. Okay, so note 7 now. Note 7, revaluation. Revaluation gain. The revaluation gain. What is revaluation gain? So we start with asset. Give me the cost. Give me the accumulated DEP. Give me the revalued. What is the revalued? Then give me the gain. Can either be a gain or loss. Gain or loss. The asset that was revalued was land. Land was revalued. What was the cost of land? So land and building, 50-30. 50-30. Now at the same time, building was 30-30. So 50-30 minus 30-30. That would be 50-30 minus 30-30. 50-30 minus 30-30. So land had a cost of 2 million. 2. Is accumulated depreciation, do we depreciate land? No. Land is not depreciated, so 0. What is the revalued amount? 2.4. So that is 2.4. We're given 2.4. What is the gain or loss? Land is not depreciated in most cases. So the gain will be 2.4 minus 2. Minus 2. So this will be this something that I've skipped. This should be net book value. Net book value. Net book value. Then this should move here. Now net book value is cost minus depreciation if there is any depreciation. So it's still this, the carrying amount. You can call it carrying amount. Carrying amount. Carrying amount. Now when getting revaluation, compare. When getting revaluation, you are supposed to compare the carrying amount and the revalued amount. So you take the cost minus accumulated depreciation to get the carrying amount, then compare the revalued amount and the carrying amount. It will give you the gain or loss. It's 400. Gain. This is a gain. Now, what is deferred tax relating to that? Deferred tax relating to revaluation gain. Relating to revaluation gain is equal to 30%, is usually 30%. Then you multiply that with the gain of 400. 30% times 400. Unless another percentage is going to be used. So 400 times 30%. 400 times 30%. 120. So the estimated tax charge is 78. Then compare that with the deferred tax. It's decreasing. Now I'm not going to use 120. The 120 doesn't go to the statement of profit or loss. The 120 goes to other comprehensive income. So that 120 will go to other comprehensive income. Other comprehensive income. 78. Then deferred tax. Deferred tax, or perhaps I need to get deferred tax first before I deferred tax. Deferred tax, increase or decrease? Deferred tax, increase or decrease? Okay, itabidi tumenini tena. hii itakuwa ya mwisho. We don't have this again. So cut this down and do a note 8, deferred tax. Deferred tax account. Deferred tax account. Start with the balance brought down. Balance brought down. What is the balance brought down of deferred tax? The one that was given in the trial balance, 40 or how much? 40. So deferred tax was 40. 40. There is a deferred tax of 40 that requires adjustment. What is the deferred tax balance carried down? Balance carried down. Do we use 20 or we use 120? The balance carried down. I'm going to use 20, the one that we've been given as 20. Don't use 120. 120 will be affecting revaluation and revaluation gain that we have. That 120 will be affecting the revaluation gain. So I'm not going to use 120. That will go to revaluation. So carried down is 20. 20. Where is 20? Additional information number 2, this 20. So I'm going to use this 20. This becomes a decrease in deferred tax. So decrease in deferred tax. Decrease in deferred tax is 40 minus V57. 20 again. So decrease in deferred tax. Brought down 40, carried down 20. Now the other one of 120 is going to affect the asset, the revaluation that we'll be reporting. That is where the 120 is going to affect. Now we can confidently get the last part, which is not 8, the income tax expense that we'll be taking to the statement of profit or loss. Estimated tax charge, then less deferred tax decrease or decrease in deferred tax liability. Decrease in deferred tax liability. Decrease in deferred tax liability. Now the decrease is 20. Then to SOPL. To SOPL, alt equal, and we are getting 58. So the amount of income tax expense will be 58. So that one is fine. Tax expense now will be the figure that we have, equal sign negative, and peak 58. Peak 58. Then profit for the year. Profit for the year. $258. Profit for the year. Then other comprehensive income. Other comprehensive income. gain on revaluation of land, the gain on revaluation of land, less deferred tax, less deferred tax on revaluation gain, less the deferred tax on the revaluation gain. So gain on the revaluation of land, the gain on revaluation of land is 400. Gain is 400. Deferred tax involved, the deferred tax is 120. 120. That gives us a net amount of 280. So the net amount is 280. Total comprehensive income. Total comprehensive income. Profit for the year plus the amount that we have here. This should be R what? R22. Yeah, 538. So 538 is the total comprehensive income. Now the statement of changes in equity, where we will be starting with the balance brought down. Balance brought down. Now the balance brought down for ordinary shares are 2,000. Share premium looks like 43. Share premium 43. Revaluation is 313. Retained earnings 2749. So retained earnings is 2749. Those are the balances that we have. Information number 5 says the suspense account relates to the issue of 2 million new ordinary shares at 120. One share has a par value of 100. So the suspense account has 2 million. What is 2 million times 120? That will be liquidated. If you take 2,000 times 120, then you get the 240. That is 2 million that you see here. So that is what we want to liquidate now. Now, out of 120, 100 goes to ordinary shares, but 120 minus 100 is 20, goes to share premium. That is 2 million. We'll be taking 2 issue of shares. So issue of shares that had been credited to the share premium. So issue of shares was taken to the share premium, removing the share premium, removing the suspense and take to the ordinary shares and share premium. The first one will be equal sign 2 times 100. That is the par value. Par value. 2 times 100. Then the second one will be equal sign 2 times 20, because 120 minus 100 is the premium. So times 20, you get 40. So 240. 240. That liquidates the suspense. Then give me revaluation. Revaluation gain, net of the deferred tax. This is net of deferred tax. So revaluation net of deferred tax. Net of deferred tax. Equal sign, it's up there, 280. 280, the one that we have up there, 280. Where? Here. 400 minus 120 is 280. Retained earnings Of course, that is just for evaluation, not retained earnings. Profit for the year. Profit for the year. Now, profit for the year affects retained earnings, and it was 258. Dividend. Dividend paid. There is some amount of dividend that was paid. Now, dividend paid is 100. There is no dividend in the additional information. No dividend in the additional information. The one that was paid is 100. 100. That affects our retained earnings. So equal sign negative 100. Now, because I want to deduct, that's why I'm putting it in negative. That is all. Unless there is something else that affects that account, which I doubt, get the balance carried down. Balance carried down. So that is the balance carried down, which is the statement of changes in equity, which amounted 4 marks. The statement of changes in equity. So now the statement of financial position, which starts with the assets. That one starts with assets. That starts with assets. So after assets, the first asset is non-current assets. Non-current assets. So after non-current assets, we have property, plant, and equipment. The property, plant, and equipment. Property, plant, and equipment. So we need a working for property, plant, and equipment. Property, plant, and equipment. Property, plant, and equipment. So note 10, property, plant, and equipment. Note 10 is property, plant, and equipment. Property, plant, and equipment. So give me the asset, cost, accumulated depreciation, value, then the carrying amount, the new carrying amount. So that will be cost or revalued, cost stroke revalued or fair value. Cost or fair value, cost or fair value. Start with the land. Now up there, what was the fair value of land? The fair value of land, 2.4. 2.4, but there is net of deferred tax. You must do net of deferred tax. So I'm going to take 2.4 minus 120. 2.4 minus 120. 2.4 minus 120 because you must report net of deferred tax for land. There is no depreciation. Then the carrying amount will be the same. Cost minus the other figure there. You get the carrying amount. So you're saying that for land, report that value net of deferred tax. You cannot take it the way it is. You report it net of deferred tax. What was the value for building? Building, this will be net of deferred tax. Building was somewhere up there, 30/30. So building was 30/30. The cost was 30/30. Then give me the accumulated depreciation. Now the accumulated depreciation is the one that is in the trial balance. The trial balance has a depreciation of 606 plus, so 606 plus the charge for the year, which was 151.2. Then you get that answer. Then the carrying amount is this. Plant. What was the plant and machinery at cost? Again, it's up there. Plant is 372. The accumulated depreciation is what is here, 167 plus 51.25 charge for the year. So the total accumulated depreciation will be 218.25. Then now the carrying amount is what remains on the other part. That is PP movement schedule, the PP movement schedule. Then this will go to the statement of financial position. Statement of financial position. SOFP. So land, building, plant and machinery, alt equal to get your answer. Okay. Any question? Land, net of deferred tax. We say that land you take net of deferred tax. So the 24 minus the deferred tax that we had. Building, cost minus accumulated depreciation. Plant and machinery, cost minus accumulated depreciation to get 706. That therefore means that the value for property, plant and equipment is what we've gotten here. The value for property, plant and equipment. Investment property. Investment property. Now, just like I said earlier, it seems the investment property wasn't put in the correct way. They are saying that the investment property had a fair value of 122 million. Now, if you look at 122 million, as we said, if you look at that 122, if you write it in full, it's such a big value. So 122 million is the new fair value. But if you compare that with the amount given, investment property was 2.4 billion. So if you write 2.4, 2,400,000, then 123, 123, it don't make sense. So you see the carrying amount and the fair value, they don't make sense. So I'm going to say that this one was not properly done. This one here was not properly done. And if it was not, then I may assume that it's reading danger. Because there is no way the value is 2.4 billion, then the new one has dropped to 122. That is way too much. Way too much. So I'm not going to use this note. I'm going to assume that there's an error. If it was properly done, then would have gotten a figure like maybe it moved up by small margin or a big margin. So this one is way too much. The carrying amount in the TB 2.4, then the fair value is this, doesn't make sense. Unless there's a big drop, quite a very big drop, which doesn't make sense. So I'm not going to use note 4. Remember, it would have gone to other comprehensive incomes as well. Would have taken that to other comprehensive income, the revaluation gain or loss on investment property. So I don't want to use that. I'll just use the 2.4 in the trial balance. 2.4 in the trial balance. So this will be equal sign 2.4. 2.4, which is here. That is the 2.4. Do we have any other asset? Any other non-current asset? None. Get the total of those two. Total non-current. Then current assets. We move to current assets. Current assets. Start with the inventory. Inventory. Now closing inventory was given as 485. 485. Then trade receivables. Trade receivables. Now, trade receivables will be obtained after deducting a few things. You get trade receivables after deducting the credit loss. Remember credit loss in note 4. There is expected credit loss, the actual credit loss of 15, and then also provision at the end of the year. The provision at the end of the year was 68. So that is for the credit, for the trade receivables. Now, since we have all those two things, trade receivables will be equal sign, then the receivables in the trial balance are 933 minus, so 933 minus, move down to the notes, less allowances at the end of 68. The allowances at the end of 68, where are they? Here they are, 68. The allowances at the end of 68, then less the actual credit loss of 15, the omitted bad debts written off of 15. This one was also not included. So you're lessing the allowances at the end, then you also deduct the credit loss, the actual credit loss of 15. That is for trade receivables. Then from trade receivables, bank balance, bank balance, bank balance. So bank balance is 119. The bank balance 119, that is given, not affected by anything, 119. That is all for our receivables. Get the total. Current assets, total assets, total assets.
Mwalimu, kindly pardon on the trade receivables.
Now for trade receivables, now total assets will be 7106 plus, the other one was, total asset is 8560 because we are taking the total of 7106 and 1454. That is the total assets. Capital and liabilities should be equity and liabilities. The equity and liabilities. Then you start with equity. Equity. We already have all those ones in the statement of changes in equity, so will not be, we simply take all this in the statement of changes in equity and move them to the statement of financial position. So from ordinary shares, equal sign, ordinary shares are here, all the way to retained earnings. So ordinary shares, all the way to retained earnings. Again, equal sign, the ordinary share, enter, then you drag down. Dividend is not part of that. So they are all in the statement of changes in equity. So the ordinary share capital is 2,200. The other one is 83. The other one is 593. Then the last one is 2907. Add that way. Total shareholders funds. Total shareholders funds. So non-current liabilities, there are two non-current liabilities, the 8% loan stock and the deferred tax. 8% loan stock and the deferred tax. Now the 8% loan stock is in note 6, additional information number 6. And this table showed that the closing balance for the 8% loan stock was 1907. We use 1907. Deferred tax is in note 8. Deferred tax is 20. We are going to use 20. The closing, not 20, the balance carried down, the balance carried down, 20. So 1907, then 20, which is the balance carried down. That is all, you get the total. Get the total. Current liabilities. Current liabilities. Current liabilities. I think we only have one item. Only one item. Trade payable. Trade payable. Let's see. Only trade payable of 772. Trade payable 772. Trade payables 772. $772. $772. Current tax, I'm missing current tax. Current tax. Now current tax amounted to, still in note 9, the estimated tax charge was 78. Estimated tax charge was 78. That becomes the current tax. 78, this other one here. Penalty equal, you are going to get, that one is not bringing the answer. You just add these two. $850. Then total equity and liabilities. The total equity and liabilities. Total equity and liabilities. So total equity and liabilities will be 5783 plus 1927 plus 850. 850. That is 8560. We are going to arrive at 8560 as our final answer. 8560. That way. So 8560 and 8560. That adjustment, the earlier entry. So on the earlier entry that we had done on deferred tax, I want to retain land. So you just go to the working. Remember, this one is 4706. So just go to where we got the working. This is the working. This is the working. Now on this working, remove the net of deferred tax and just use the land at fair value. Land at fair value will be, remove that to 24. Let it be 24. Then that affects this. Now it's just 24. 24. Now if that is 24, land is 24, the PP now moves to 48.26. Now we have 48.26. Now it's not balancing. The reason is because deferred tax has to be adjusted. So the deferred tax, amendments in deferred tax, hapa hivi note 8. After doing all this, adjust deferred tax. Not. Deferred tax liability to the statement of financial position will be, the carry down, the balance carry down, the one that we've gotten here, 20, or we can do it aside. Balance carried down, the deferred tax liability balance carried down. We can just get 20 plus 120. I'm just getting 20 plus 120. This plus 120. So the balance carried down plus deferred tax on land, on revaluation of land, deferred tax revaluation of land. So that will be 20 plus 120. 20 plus 120. So that is 20 plus 120. That will be this 20 plus 120. We are getting 140. So we'll be using 140, the deferred tax that will go to the statement of financial position. $140. So here on the statement of financial position, it will be equal sign. Then click on this 140 that we have. Okay, so it still balances as 8680, which is different from the previous one. So there's a student who had asked which one is correct, and now this one is the one that is correct. Figures. So this is the final result of the statement of financial position as required in that setting. So we say that your assignment is December 2023, question 21. So I'll make sure that I send this today for those who want to go through it. You go through it. So, okay.